So in 2006, my company was very big. Bear Stearns was a big investor of ours. We sold a lot of business to them, investment banker. They were like, what you would think of today as a Morgan Stanley or thing. And they said, that's it. We're not buying any more loans. $100 million worth of loans that we were, that were ready set to be sold or in some process, whether they were already shipped to them or, in the process of being shipped to them to be purchased by them. Then I thought, we're in trouble.
Oh my God.
And that's when my CFO came to me and said, you got to stop chasing this.
So what's the biggest lie young entrepreneurs believe about success in business?
That it comes easy. I think they're tainted by what they see online. Let's say these big influencers, and you've seen that they've grown overnight and they've blown up. Everybody thinks it should be like that, right? That you can get online, start posting some videos, and
overnight success.
And that's not the case.
How much money do you really need for a down payment in today's market? Is it the old 20% rule outdated, or is that still relevant? Welcome to Built to Scale, the podcast where vision meets action. I'm your host, Quinn Vincent Shills, founder of Master Roofing, and I'm here to pull back the curtain on building world-class teams, scaling companies, and turning bold ideas into unstoppable momentum. Let's get to work. Today, I've got a very special guest, Brad Rice. Brad is the founder and CEO of Amerifund Home Loans, a nationally recognized mortgage company, and HomePie, a disruptive platform that's changing the way people buy and sell real estate, cutting out massive commissions and making the process much faster and smarter. But that's not all. Over the last 30 years, Brad has built, scaled, and sold multiple mortgage companies, an escrow company, a real estate brokerage, and even real estate investment groups, some licensing over 40 states and selling pools of mortgages directly to Wall Street. He's also the host of the Blueprint podcast, where he sits with top performers in business, finance, real estate, and fitness, sharing how they did it so you can win too. What I love about Brad is he's not just an entrepreneur who built wealth, he's also built loyalty. Many of his employees have been with him for over 20 years, following him across multiple companies. And that kind of leadership, culture, and consistency is rare. In this episode, we're going to unpack Brad's step-by-step journey, how we went from just starting out in the San Fernando Valley to building nationally recognized companies. We'll dive into how he hires, fires, scales, and even disrupts old school industries. Plus how he's leveraging AI and technology to stay ahead. If you're a young entrepreneur out there looking for a roadmap to building businesses that last decades, this episode is going to be packed with gold. So let's get into it. Brad, welcome to Built to Scale.
Thanks, Quinn. Appreciate that. That's a good start to a book.
Yeah, bro. I mean,
I might hire you to write my memoirs.
You actually inspired me to create the podcast.
Yeah, you were on mine.
You had me on yours, and that was the first podcast I ever did.
Yeah.
And
you were having a rough day that day, though.
I was a little nervous,
drive
huh?
up. Well, you had a lot going on in your mind. There was a lot going on, if you remember that day.
Yeah. I was asking you after. I was having some issues with I think employees and turnover and stuff, and I was like, how do you handle that? So
yeah, you were a little preoccupied that day.
But that's business, right?
That is business. We actually, Micah and I spoke about that on my last solo podcast because that's the kind of unspoken truth about being an entrepreneur and a business owner. One of the biggest issues is having personnel and how you manage that.
100%.
Yeah.
It's I think it goes across all different types of industries. Yesterday I had on Robin Richards. He's a serial entrepreneur.
Okay.
And he was talking about, how there's, as you grow, like how different employees and the turnover and as you scale and it's just personnel, right? And how that transitions.
Yeah, and it is tough, and it takes a certain personality to be able to deal with that, especially if you're the one in charge of who you're hiring and who you're firing and how you get yourself to that next level. So that the old adage of the people that got you to where you're at aren't necessarily the same people that get you where you're going.
Yeah,
is true. But if you got a big heart and you care about people, and maybe they're not doing the best job, or they're not in the right seat, or they're not as motivated as you'd expect them to be, and they're not pushing your business forward, that is one of the toughest things to do as an entrepreneur, is let somebody like that go. Yeah. And I'm certainly guilty of it. I've put people in multiple seats and tried different things, and at the end of the day, if it doesn't work out, which typically it doesn't, if you know ahead of time, it usually doesn't at the end. But you look back and go, man, I should have done that a lot sooner. And so, that's one of those things that we have to deal with.
I relate to that a lot. I think that it does take, and I'm still learning it, but I've noticed that, the people who start with you aren't going to be the people who finish with you. And I've had mentors give me that advice earlier on. And I think that it's good that I know that, because starting out, it can be really discouraging for somebody if they're like building a team and they invested all this time into somebody and then they're like, well, I got to do it all over again.
Yeah.
And that building those processes and systems of onboarding and training, it's like that you have to have that in recruiting in your business.
Yeah, it is. That's true, especially as a small business. And when we say small, let's just say it's under 100 people.
Yeah.
There's a lot of pressure put on the leaders of that company, and it is tough to bring people aboard and train them and get them into your systems and make them productive.
Yeah.
That's why I think the role of AI is going to have a major impact on hiring and employment moving forward, and that came out in the jobs numbers today. Right?
What came out in
the jobs numbers today were very low.
Yeah.
Which indicates that we're probably going to see the Fed cut interest rates for sure later this month. To what extent we'll see, but there's a slowdown in jobs. But for the first time since 2018, there's more people that are unemployed than there are jobs available. So things are changing a little bit now.
I'm excited to pick your brain today.
Yeah, let's do it.
So you've built multiple companies over 30 years. What's the one decision that changed everything for you?
That's a good question. I think, I've kind of always been like this, but there's certainly periods of time in anybody's life, no matter how thick a skin you have, or, what circles you run in, you get affected, especially with social media and online and all that. You get affected by what people say or think about yourself, about you. And I think the biggest shift that took place for me, which happened pretty early on in my career, is not caring at all what people think. And, when I say not caring what they think or their opinion about me personally, listening certainly about the indicating factors when it comes to business and what people are looking for, and, finding product market fit and all that sort of thing, of course. But, personal thoughts or attacks or things of that nature, getting to the point where you just don't care about that at all, that has big impact.
So if you had to start all over today, with no money, no contacts, how would you rebuild to double digit 10 million plus?
I've talked about this before on my podcast. It's definitely a different world today than it has been, in my entrepreneurial journey. There's so much more opportunity. There's so much more opportunity without risk. So, great examples of this are YouTube stars, people that have just blown up on TikTok or other social media, and have built careers out of that, whether it's through starting that way, getting recognized, building a big following, kind of getting put on the map, and then transitioning that into, a clothing business or other things, or just being endorsing. But to be able to grow and the scalability of growing online today with no investment of capital, no risk, you're not getting sued for anything. Like, all the personnel problems we just talked about, it's just
outsourcing
purely bringing in
marketing.
capital. Yeah. And so I think that's probably where I'd really lean in is, how do you scale using the opportunities that are there today in social media that weren't there, even a decade ago, and just doing everything you can to get in those algorithms and have something blow up on you.
So like you created your podcast, you're doing social media, right? And building an audience yourself. Why are you doing it? Like for the purpose of creating a clothing brand, or how are you doing it? Like if there's a young entrepreneur building a mortgage business, or where do you see the value in that?
Yeah. For me, it really was about how to make a deeper connection with people. So, for example, you came on the podcast, you came through somebody we knew who's on the other end of the camera here.
Yeah.
And now we have a relationship, right? Now we have each other's phone numbers. We can text. Let's say at a building that had a roofing issue, I've got a connection, right? And it's a deeper connection than if I just called you out of the blue. Same thing goes for business, for other businesses, or even the bridge to other relationships. Maybe it's investors. So I know, for example, where this really came from is I was listening to the Brad Lee podcast a couple of years ago. Do you know who that is?
Of course, yeah.
Okay. Funny thing is that a friend of mine is working with him now in building a company together.
Oh, wow.
But I was listening to the podcast, and on there was a guy talking about investing in boutique hotels. And I'm listening to it, and I'm thinking, God, this is really smart. Short-term rental, that's what it really is, but on steroids, because it's multiple units for short-term rental. So it's a hotel, but it's a boutique, it's small, and he was investing in those. And it resonated with me. And then he mentioned his first purchase, which was up in Shelter Cove, which is Northern California, like by the Redwoods, Humboldt area. And I had been in that area before. So it was just like, it just clicked. And I thought, you know what? I'm going to reach out to this guy. This is really smart. He's in San Diego. So it was Rich Summers. Connected with him. I wound up being one of his first investors when he started his fund. And then shortly thereafter, and the reason that I connected with him is, just think about it. He was on a podcast, right?
Mm-hmm.
And that's how he started raising money, is the recognition he got from the audience that was shared from Brad Lee's circle of influence, right? And so Rich started a group to promote teaching others how to do the same thing. And I joined that as well. And, that's pretty much was the impetus behind doing it. But the purpose was to build a bigger brand and attract more people, make deeper connections, open up to wider audiences. And I think it's a great way to grow. If you're in the podcast world, like you're doing it, you feel like everybody's in it, but it's not nearly the case, right?
Right.
First of all, even people that have started, very few get beyond 10 episodes, right? That's it.
Is that the statistic?
That is.
Oh, that's
very
crazy.
few. It's like 95% of them don't get beyond 10 episodes. So to be able to do it and do it long-term, make it sustainable, it's got to bring benefit. And, I do get connected. I get people that reach out to me almost weekly that say, oh, I heard your podcast. Oh, I heard. And so I know it's out there. I know people are listening to it, how to directly calculate the traction and what it brings me. I don't know how to do that. I don't know if there's a real way, but I do know it's a branding gig, and it takes time to build. So that's the reason for it.
It builds your network. It builds your customer base. It deepens connections
and your brand.
So what's the biggest lie young entrepreneurs believe about success in business?
That it comes easy. I think that, people think that it should come very easy, and I think they're tainted by what they see online, right? Mm-hmm. So when you see these big, we'll still call them influencers. I don't know how much longer we're going to be doing that for, but let's say these big influencers, and you've seen that they've grown overnight and they've blown up. Everybody thinks it should be like that, right? That you can get online, start posting some videos, and
overnight success.
And that's not the case. It takes a lot of work. And what they don't see is all the work that came up to the overnight success. It may be years, it may be a decade.
Absolutely.
And then all of a sudden something clicks, and then you see it. And everybody thinks that they don't know about the 10 years of work and grinding that went into that, and the ups and downs. And I think that's true for business too. Everybody reaches an inflection point in business where it just clicks if you've been doing it long enough. And that is typically about 10 years, mm-hmm. right? For a company to really be successful, the average life to get to that point is 10 years. But most don't give it that period of time. Most businesses fail way sooner than that. So you got to be in there long term, and don't be miffed by not getting immediate success.
Have you had anyone, it just popped in my head, this question, like since you've been in business for, over 3 decades, like, have you had anyone stay with you throughout that whole process, or has it always been different people? They maybe last 20 years, but it's like not the whole journey.
Still coming up.
So in 2006, my company was very big. Bear Stearns was a big investor of ours. We sold a lot of business to them, investment banker. They were like, what you would think of today as a Morgan Stanley. And they said, that's it. We're not buying any more loans. $100 million worth of loans that we were, that were ready set to be sold or in some process, whether they were already shipped to them or, in the process of being shipped to them to be purchased by them. Then I thought, we're in trouble.
Oh my God.
And that's when my CFO came to me and said, you got to stop chasing this.
SoCal homeowners, why pay $15,000, $20,000, or even $30,000 for a new roof when instead you can get a new roof for only less than $100 per month? Here at Master Roofing, we serve homeowners with high quality roofs with no hefty upfront costs. So give your house the roof it deserves with 0 down and low monthly payments. Why wait? Click the link below to get you a roof you deserve for payments you can afford.
Well, the journey is broken up because some companies haven't
different businesses happen,
right. They have their own life, but I think 2 of the longest people that have been with me started with me in the early 2000s. One probably in the year 2000.
Wow.
And another one in 2002 probably. So through multiple ventures, and back with me and still with me. Yeah.
That's awesome.
Yeah.
So you've made millions in real estate and mortgages. What's the single biggest money-making move you've ever pulled off?
That's definitely been in commercial real estate. Yeah.
Talk to me about that. It was a deal, or you brokered it, or what was
I think getting into commercial real estate's a little scary, especially for people that are used to residential, because it's a different animal altogether and the numbers are much bigger. But the deal qualifies for its own financing. So when we talk about residential mortgages and we talk about non-QM, and this is all kind of recent, the reinvention of subprime. So do you remember the term subprime?
Heard it. I don't know what it means.
All right. So for the younger audience, pre-mortgage meltdown, 2007, 2008,
right.
We had mortgage product called subprime. And all that really meant was you had your Fannie and Freddie loans, you had your FHA and VA. These are kind of your standard cookie cutter loans with certain guidelines. And then if you fell outside those guidelines and you needed a different type of loan to qualify, it may have been a larger down payment, but you can do it on bank statements to prove your income.
And people would just fudge their statements. And
then we got to those loans that we call NINAs or NONIs, no income, no assets. There was, it started to get to be the Wild West, where not only was it less documentation required, but you could have worse credit and lower down payments. And at the end of the day, we could do loans with people that just stated their income or left it blank on the application, had a 500 credit score and had a bankruptcy just, a month ago, and could get in with 0 down. And I'm exaggerating just slightly, not much from that.
Yeah.
But
I've seen a lot of movies that like portray that,
The Big Short would be one of them. That's uncannily pretty close to being right on. But the reason I brought that up is those were what we call alternative documentation loans. So post meltdown, we had regulation, specifically the Dodd-Frank Act, that had different requirements for loans and disclosure requirements, and it really tightened things up quite a bit. But over the years past that, there was a need to have still some alternative documentation. So you're self-employed. And for most self-employed people, you might write off as much as you can, right? To limit your taxes. But you're making enough money. So your net income, you don't qualify for a loan.
Right.
But you're certainly making enough money. You have enough cash flow to make the payments. So how do you qualify for a loan if you can't prove it? If you can't prove it with
bank statement program, right?
So bank statements would be one of those.
And the interest rate goes up.
And you pay a little, it's a riskier loan. You pay a little bit more in interest rate.
Yeah.
Maybe they require a little bit larger down payment. So that category of loans is called non-QM, or non-qualified mortgage.
Okay, gotcha.
Okay. A qualified mortgage falls under the protections for the lender, because they're following certain guidelines, they're protected on those. When they go outside of that into a non-QM, they lose some protection. So because of that, they charge a higher interest rate, but you can get a loan that has alternative documentation. Make sense?
Yeah.
Okay. So the reason I bring that up is in the last couple of years, those that are involved in buying a property, let's say non-owner occupied or investment property, residential, they may have heard of a loan called a DSCR. That stands for debt service coverage ratio. And all that really means is that the income that's produced by that loan or by that property makes the payment on the loan. If you can prove that the rent that you can receive on that property can make the payment on the loan and the taxes and the insurance, at least at a 1-to-1 ratio.
So it needs to be currently occupied. It needs to be currently producing.
No, it could
or you could say the pro forma of it.
Yeah, based on a rental survey that an appraiser would do. This is what it could rent out for.
That's
we use
crazy.
that, and that's what qualifies.
Wow.
But here's the thing. That's been around forever for commercial property. So commercial property qualifies for its own payments. So that's where we get these cap rates and other things. But
it's not based on the owner, it's based on the asset.
It's based on the asset. What kind of income does the asset produce? And what will it cover for payments? And then the delta is your down payment. Your down payment is required to make up the difference. And so, people get, that are in the residential world get a little bit afraid of the difference of how different it is because it's bigger numbers and so forth than commercial. But the reality is, if you can leverage that, and it's a matter of having enough to put down to begin with.
And will they finance like 70, 80%? Or it just depends?
You can, with an SBA loan, you can get 90.
Yeah.
Yeah.
And instead of the SBA acts as the DSCR?
That's the way that the property is underwritten, is based on debt service.
Got it.
Yeah,
okay.
That's it. Will the income from that property service the debt?
Understood.
Yeah. And so if you really want to leverage, and you can do it with apartment buildings and other things, but I think where the headache comes in is especially in non-landlord friendly states, you have to deal with a lot more on the residential side. On the commercial side, it's all business. So when somebody doesn't make a payment, you can kick them out, right? You can charge them their late fees. You don't have the same restrictions that you do in residential. And so you can leverage a lot more and you can build a lot more wealth that way.
So many things popped in my head. When you said DSCR, the first thing that came to my mind was I always see these kids, in front of flashy cars on Instagram talking about Section 8, buy my program, I'm going to teach you that.
Yeah.
And talk about DSCR loans, like, you can buy all these properties with DS. So can you use those on residential properties as well? The DSCR loan on like a Section 8, for example? That's
where the terminology really came from, DSCR, is because they took the commercial underwriting guidelines and then started using that in residential. You can do that. So I know like Pace Morby would be one that in his, Gator method and other things that he promotes out there about buying investment properties. And they do some other things too with seller carries and other ways to structure debt. But the DSCR loan is a big part of that. So it's buying that property and letting the income of that property pay the mortgage.
At what point did you realize, like, I can't do this alone, I need a team? And how did you start building one? Like, go way back.
Yeah, going way back. So I started as a loan originator. And when I originated loans, I got pretty busy pretty fast. I had a mentor and he told me what to do. And I didn't know any better. So I just did it.
This is back when?
This is in the early 90s.
How old
93,
were you?
94. 25.
Okay, cool.
Yeah. He just said, here's what you do. By the way, he said, get a CRM. I didn't even know what a CRM was. You know what that is, right?
Customer relationship management
software, right?
Keep all your customers in one place.
Keep
organized.
It all like
put notes.
Back then we would think that as an address book, right? Because even back then nobody had an email.
Just a place so you have a database, right?
Yeah. Where's everybody that knows you by name or by face? Put them in there. So he had me go and get my parents' phone book. And when I say phone book, this is an address book that's handwritten, A, B, C, all the way back through, right?
That's funny, yeah.
And it was everybody that I grew up that knew me because I was a kid. I grew up. We would go to their houses. We'd hang out. So it was all those people from my parents' phone book. It was my yearbook. I would go through my yearbook and I'd call people that I knew out of that. because really we only had phone numbers, and a lot of those were, by the way, Quinn. Let's
no,
go way
I
back.
love this.
A lot of those weren't even cell phone numbers.
Yeah,
right?
we're calling a landline.
We're calling, and the mom would pick up and you say, "Hello, is John there?" And it's really awkward a lot of times. So anyway, let me see if he's available. He's having a peanut butter and jelly sandwich. Hang on. So, but literally, he was like, "I don't care what it takes." Couple of months, he goes, "Go through and everybody that knows you, put them in your database." And I used a system called Telemagic. Okay, you can look this up. So the gentleman that made Telemagic is known as the godfather of CRMs. Okay, he's still alive. He lives in San Diego. Believe it or not, I connected with him a couple of years ago.
Wow.
But it was a DOS-based program. Do you know what DOS is?
I don't know. I'm just imagining like the Salesforce of the 90s.
It was. That's what it was. But DOS-based meaning that the GUI or what you saw on the screen was not as friendly as Windows.
Oh, was it like the blue screen with like the yellow dot
right, where it just had blanks in it and you had to fill them out. And,
wow.
That sort of thing. So, but that's what he had me do.
That's cool.
So I did that, and then he had he basically walked me through step by step, and I still didn't know the mortgage business. Like if somebody said they needed a loan, I didn't know what to do. And he said, "Look, now you're going to send out mailers." And so I would get from my title company a list of names and addresses of people that had FHA and VA loans.
And just cold.
And I printed out these letters that I hand stuffed with my wife, my newlywed wife, every night. And then I'd take this bin of envelopes with these letters about streamlining an FHA or VA loan, a refinance of them. And I'd take it to the post office, to the postmaster, and they'd show me how to do bulk mail. I have to fill out forms, rubber band things together with different zip codes. I mean, this literally physically.
That's awesome.
And I'd send those out. But then 2 days later, my phone would start ringing off the hook.
What did the letter say?
It was basically like, you qualify for a government program since you have an FHA or VA loan. You can streamline this. There's no income required. There's no appraisal required. Just simply because you have this loan, you can lower your interest rate. And those loans still exist today, by the way.
So then they call and they say, "Hey, how do I get it?"
Yeah, I want to lower my interest rate. How do I do it? And then I would just literally take down their information, make an appointment, and drive out to their house and take a loan application. So that's how I started. So you asked me, how do I leverage that into growing? I started to get really busy. The busier I got, the less time, like I'm exchanging my time for the money. Like I needed to do everything. And I got so busy that I needed to hire assistants. And so I just started to hire people to help me with the process. And over time, it became kind of a conveyor belt. I would be the guy at the front. I'd take all the information. I'd put the deal together in my head, figure out how I'm going to structure it, make the client comfortable with it, pass it off to the next person in the line that did the paperwork side. And ultimately, I wound up having 5 assistants. And everybody had their job all the way to take it over the finish line and close it. I was doing a lot of loans. I was doing 40 or 50 loans a month, just myself.
Wow. When you were 25?
At the time I built that up, I was closer to about 28, 29.
That's awesome.
It took a few
couple years you grinded, and then 50
And
loans
so I was
a
doing
month.
a lot of loans. And that's what led me, I had already become a partner in the company I was working in. And I wanted to grow. And my partner was 15 years older than I was. And he said, "No, you go do it. I'm not interested." Very amicable. I had a branch of our office. He had one. I kept mine. And that's when I started my company, Mortgage Corporation of America. That's the company that started with my 5 people that then I just started hiring and kept hiring. And I grew that into a nationwide organization. So, but that's how it started. And it started literally, I was the one grinding it out.
So you were talking about your wife. You've been married for over 30 years while you're building these companies.
Mm-hmm.
How did you scale a business and a marriage at the same time?
Well, it's not easy. I think the biggest thing that people lose sight of when they're building a family is not paying attention to the person you fell in love with. And so, especially when you've got a business, because that's a baby, right? And then you start having babies. And so you start to become this, you start to have a separate business, and that business you're partners with your wife in, and then you just become a logistics company. Who's picking up who, where, when, who's around? Are you taking them to soccer? Am I taking them to the dance? And it's all about logistics and it's about the kids, and you forget about each other. And I think the one thing that we did right from the very beginning is that we never forgot about each other. So no matter how busy I was, and there were definitely those years that I stayed late at the office, I missed dinners, and because I was really grinding it out in my 20s and my early 30s. But I always made it a point to take vacations. So I'd always book that in. I'd always do family vacations. And then I just continued to date my wife. Like we would plan things just the two of us. We'd go places just the two of us. We'd go out to dinner, without the kids. And I think just by virtue of doing that, our relationship, even during the tough times, like during the mortgage meltdown when I lost everything, it just got more strengthened because we were one. There was I didn't lose that. I think what happens with most people in divorce is that it's all about the kids for too many years. You grow apart. You no longer have the same interests. There's a lot of, you antagonize each other, and there's a lot of friction. And by the time, and you're there really just for the kids at that point. By the time the kids are out of the house, you don't have anything in common anymore. You hate each other. And that's why most, marriages end in divorce. So we just didn't go that route. And believe me, we had our ups and downs. Yeah. And there's a lot of stuff that happens along the way. I don't want to make it sound like it's all rainbows and sunshine and ice cream, but yeah, there's hormones and all sorts of things you have to deal with. But if you just look at it, I think that when you're single, you want to be with somebody, right? You're looking for that person to share your life with. If you have that person, why don't you treat them the same way as if you were still looking for that person? And that's the way I look at it.
It's great advice. I think that, especially for me, I've only been married we're coming up on a year in October.
Okay.
So, I think dating, a lot of people say date your wife, but I don't think it's rare when you see people actually put it in practice and, are consistent with that for years and years and decades. So that's awesome to
think about the things that you like to do with your wife today.
Mm-hmm.
Like even when you met, what did you do? What did you guys enjoy doing?
That's a good question. I mean, we used to go out, we would go out a lot, to restaurants. We'd go and do fun random activities. Like one day we took the car up to Palm Springs and camped out in the car and at Polaroids of that stuff. So just fun.
Are you still doing that?
No, we don't go out. We haven't done that. Maybe we should take the car tonight.
Do that this weekend.
Yeah.
Do that this weekend. Just, here's what we're going to do. Be spontaneous about it. Because isn't that what you did before?
Yeah.
You want to stay engaged?
We even bought a book that was I remember I bought this book that was what was it called? I think it was 58 or 100 free activities you can do with your wife or whatever. Right. But it was it was just cool random stuff of go and get these ingredients and make this recipe together, or go and get go on this hiking trail and make this tent, or I don't know, just random cool fun memories you guys can make together. So I'm actually gonna take you up on that tonight. I'm gonna tell her, hey, we're going, and I'm gonna take her.
Go find something in the back in that book and go do it.
Yeah 100%.
Yeah. So I think that is really the key to this.
Yeah,
is constantly doing things that your partner loves to do.
When I was still chasing
her,
her.
Do it. Yeah. Why not?
Yeah.
If you weren't with her now, if you were not with your wife,
yeah,
what would you be thinking about doing?
I'd still probably want to go on dates and do things.
You'd want to find somebody.
Yeah,
right?
Yeah, exactly.
Well, now you have her.
I have her, so now
treat her that way.
That's great advice, bro. Yeah. Can you talk about your biggest failure? How much money did it cost you? You talked about 2008. Obviously, that was crazy time. Was that the biggest failure? It
probably was the biggest. Yeah, that was a big.
Where were you at, and where did you go to?
So
people need to hear this, maybe. Yeah.
So in 2007, my company was very big. I had purchased, completely remodeled our corporate office, this 20,000 square foot building. When I say remodeled, like took it back to the outside walls and built the whole thing. It was a tilt up. Are you familiar with what those are?
What does that mean?
So tilt up is, a big building that, they build the walls like this and then they tilt them up and they brace them and they become your outside walls. So you don't have all the beams and everything. That you have the roof that connects it all, but
it's like a
like a big warehouse.
Ceiling. Yeah,
like a big warehouse, right?
Okay.
And gutted it.
Wow.
The outside, everything, and really just literally redid everything. It took me 2 years to redo this building from the time I bought it. Bought it in 2005, didn't finish it to the end of 2006. And
how much did you put into the remodel?
A few million.
Yeah, I can imagine.
I want to say it was about 3 million, 3.5 million, something like that.
Okay.
It was beautiful. My dad was the architect that redesigned it all for me, so we worked together on it. And it was a really
So it was like your dream corporate office.
It was unbelievable. We had finished that and moved into it because we were in a 9,000 square foot office, okay, and we moved in this 20,000. But the 9,000 square foot office I was leasing, we literally like had desks in the hallways, like we had just people everywhere,
busting at the seams.
It just it was not it was great because a lot of energy, but we were like definitely bigger than 9,000 square feet. And so we moved in this office and it was everything I wanted, all brand new furniture, everything in there. It was, vaulted ceilings with skylights and a big training center and a big lunch area with 2 giant refrigerators and like all these things, a stage. It was awesome. We moved in, we were doing some big numbers, both wholesale and retail. So in mortgage business, retail is like direct to consumer. You work directly with the client. Wholesale is brokers are sending you business as well, and you're funding those loans. And I remember distinctly, it was early 2007. So people talk about the meltdown being 2008, but it really started the end of 2006. Early 2007, I got a message, and I actually think it was still a fax at that time. It might have been a fax, electronic fax, because we'd use faxes a lot in the mortgage business. But, it went from the thermal paper fax to like receiving it online through a fax system. And Bear Stearns was a big investor of ours. We sold a lot of business to them, investment banker. And they were like, what you would think of today as a Morgan Stanley or what have you, right? And they said, that's it. We're not buying any more loans. We had tens of millions, $100 million worth of loans that we were, that were ready to be sold or in some process, whether they were already shipped to them or, in the process of being shipped to them to be purchased by them. There were other investors too, but they were the first one to hit the skids. And I was like, oh my gosh, what the heck is happening here? We got to find somebody, like, this is a big deal. We got to find somebody else to buy these loans. At the same time, I was talking with 2 different companies about acquiring my company. We were in negotiations. This was it. This is going to be like everything I worked toward, from the time I was in my 20s. This was my big exit. And this started to happen. And so they started to ask questions about the market and all that sort of thing. And I was very close. So we redirected those loans. This all happened over the course of a couple of weeks. We redirected those loans, and we were able to get through the similar guidelines, Lehman Brothers, to say, we'll take a look at those pools of loans. And the next shoe to drop was Lehman Brothers. So they're not around anymore. There was another big firm. And oh my gosh, now all these loans that we were, so when you fund loans as a mortgage banker, you don't make any money on those until you sell them. If you're servicing them, then that's a different story. You're collecting payments, a different type of business. We weren't really servicing our loans. We were interim servicing them for a short period of time. But then our profit model was to sell the loans and keep the delta, the difference between what the cost of money was to fund them and what we're able to do when we sell them. And when that failed, that was a big deal. Then I thought, we're in trouble. Never been through it before. I'm in my 30s. We're running short on payroll. We're running short on everything. And I'm having to inject money into the company. I mean, a lot of money.
Like from your savings or?
Just from my own pocket.
Wow.
And I'm doing it. And at the same time, we're scrambling. What are we going to do with these loans?
Were you firing people yet or having to let people go?
Started to have layoffs, big swaths of layoffs. We're laying off 10 people today, 30 people the following day. Like,
whoa.
We're just trying to catch up, but it's still behind the ball.
That's so scary.
And we're all hearing that from other companies and so forth. And my negotiations for the acquisition of the company were starting to break down, and I'm starting to, negotiate myself lower to get whatever I could out of the company because I knew that things were falling apart. And anyway, it went from the ability to sell these large pools of loans, hundreds of millions of dollars at a profit, to we would sell them at what's called a discount, or scratch and dent, like pennies on the dollar. Like we were getting offers at 30% off of the note value. So if we had a $100,000 loan, we would get offers, we'll buy that from you for $70,000. So not only was there no profit in it, but we would take an actual loss.
Just to get out of it. Oh my gosh.
And that's when my CFO came to me and said, you got to stop chasing this. I at that point put millions into the company over several months, probably $3.5-4 million. And they said, don't do it anymore. And I said, what do you mean? This is my baby. Like I've grinded this. What am I supposed to do? Shut it down? And we had, dwindled down to less than 50 employees at that time.
From how many?
At the peak, it was probably like 280. Were employed at one time. I mean, thousands over time, but
so hundreds of people had to be laid off.
And I fought it. And I was like, no, we can do this. And then ultimately I had to pull the plug. And
what did that look like? You had to file bankruptcy, or?
I didn't ultimately file bankruptcy. I had a really great bankruptcy attorney who negotiated all the personal guaranteed debt that I had.
So you got out of the stuff that you personally guaranteed in a way, or?
I settled with the personal guaranteed debt.
I wonder how that all worked, because I've never had to go through that yet.
Yeah, it was a terrible period of time. In that period of time, I turned gray. I started to get gray hair.
Because of the stress?
Because of the stress. I had the FBI in our office almost daily.
Why?
They were investigating fraud everywhere, mortgage fraud. And so we had to, basically help them.
Were you scared?
No. It wasn't against us. We ran a very clean business, but they were chasing these brokers that were totally fraudulent, and the straw buyers and other things that were going on. And, so along with dealing with all of that, and we had paper files. So now everything's electronic, right? So we have to keep files for a certain period of time, by law. Back then it was all paper files. So behind my office, I had giant sea containers filled with physical files. These are loan files with people's personal social security numbers and all that in there. And I remember, it was me and just a handful of people. Actually, one of the people that still works for me that was there just kind of moving things around and getting rid of furniture and having, parking lot sales. And, I had other properties we had to get rid of. And there was just a handful of us that were managing all of that. And my wife came in and started to do the books because I couldn't afford to pay my CFO anymore. And then they had these sea containers in the back of the building.
Is it these file cabinets, or
no? These
Sterilites?
No, more like they're called sea containers, or some people call them sea trains. It's those big metal containers. They actually build houses in these now too. But the big metal containers that go on the back of trucks.
Oh my God.
And then they put them on the ships.
I know exactly what you're talking about.
Those are called sea containers.
Where they ship people in those, I think.
They do that too. But those, that's where our files were. We're in those.
You had those big ass things.
We had like 6 of them behind the building.
Oh my God.
With thousands and thousands and thousands of these files that we had to keep for 5 years.
Now I'm imagining these little office boxes you walk out with when you're, but you're talking about Oh, now I picture
Yeah,
it.
that go on the back of
exactly
the
back
trucks.
of the pickup trucks, the things that
Not
come into the
pickup trucks,
port.
on the back of
the semi trucks
the
and the ones that
semi-trucks.
come into the ports in
That's right.
Long Beach.
Those are sea containers.
Yeah,
Yeah.
huge shipping containers.
Yeah,
is how I
they're just
think,
like storage containers.
Yeah,
and that's how we kept our files back then. That's where we kept them
because you had to keep the records. So
and they had to be in fire. They were fireproof ones. So,
wow.
So yeah, so we're clearing out the office. I put it up for sale. This big building. I put it up for sale, and now I got to get rid of all these files. Well, the shred company wanted $40,000 to shred these. There's another $40,000 I'd have to lay out to shred file. I'm done. Like the business is over.
Yeah.
But I got to get rid of these. What do I do? Like nobody's just going to come pick them up.
You can't just toss them without shredding them because it has personal information on it. And yeah.
Where am I going to toss them?
Yeah.
Take them up to the dump? Like there was no way to get rid of it. So after all of that and putting in millions and just getting completely beat up, I still had to come up with another $40,000 to shred those files. So this is stuff, the untold story that people don't talk about.
Yeah.
And I'm not necessarily the only one that had gone through that, because anybody that had a company, I'd call my company a mid-sized company at that time, but they had something similar. They had to do the same thing. So that was definitely the toughest time.
The number one question that comes to my head is like, why did you stay in that industry after?
I tried not to. There was... Did
you get it? Did you dabble in other industries?
I did. So I was I was on forced retirement for a couple of years because I had to clean up the mess. It was heavy.
And you still had some money
I was fortunate enough that I still had some money. I was able to keep my properties, that I had my investments. Not a lot. It wasn't like I was super wealthy at the time. It was enough for me to get by and pay my bills, but I actually had to liquidate my investments at the lowest point. So talk about a bad investment strategy. So leading up to the meltdown, things were great. Stock market going, kind of like today, stock market going up, everything's looking good. And then the wheels fall off the bus. The market crashes. I'm talking about 50% crash. And it's right at the time where I don't have any money and I got to sell everything. I invested high and I sold low, Quinn, and that's probably not a great strategy. But
you had to cash out
I had to survive.
Would you rather build like a $100 million company or a $10 million company, and why?
I think it depends on the person's ultimate goals. Like if the goal is to exit, and you're building something that can be acquired, then obviously the larger the company, the larger the exit. But if it's about cash flow and profitability, and that smaller company actually gives you more cash flow and profitability, and that's a better option. For me, I kind of have two horses in the race today. I've got, two companies that I work on, together. So I've got the mortgage company, and I've got the for sale by owner platform called HomePie. And that's my big one. That one I think can scale to something very big and have a very big exit, where the mortgage company can be the cash flow piece.
How focused are you on the HomePie?
I'm about split 50-50 on
really?
the time. Yeah.
So jumping into for somebody who's buying their first home, what's the step-by-step process to get approved for a mortgage?
There's a good question. So people have it wrong. They think the first step is start looking at homes. And it's always been like that for decades and decades. If you think about buying your first home, the first thing you do is today you jump on one of the portals. You go on Zillow, or you go on realtor.com or homes.com, one of those, right?
Yeah.
And you start looking, and then you connect with a real estate agent. Why do you do that? Because maybe your parents referred you to an agent, or a friend did, or said, you got to talk to my real estate agent. Really, that's backwards. Where you need to start is, what can you afford? What payments are you comfortable with? And the process of getting pre-approved on a loan. Then when you start looking, you don't have to be disappointed. Because if you start looking today, and let's say you fall in love with a certain area and that price range is, $850,000, $900,000 purchase price, then when you go and you get pre-approved on a loan, you qualify for $750,000, that's not going to work out real well with what the expectations you already put together. So the first thing to do, talk to a mortgage broker. And when I say mortgage broker, what I'm talking about is somebody that is 100% commission.
Well, they can call you, right?
You just want their motivation. They're motivated to close your loan. They're motivated to figure out a way to get you qualified if you don't have a perfect scenario.
So a broker is better than going to Wells Fargo or Chase?
Way better.
Okay.
If you go to a Wells Fargo or Chase or your bank, you're dealing with basically a paper pusher. That's not even the person that's going to be doing your loan. They're just doing the app intake, and that's it. And they don't know much about loans, and they don't have the variety of product as well to get you a loan. So we talked earlier about non-QM. Banks don't do those. Banks don't do reverse mortgages either. Credit unions don't do those. So if you want to have the biggest variety of product and the most motivated individual to get you the best deal possible, you need to talk to somebody who is a mortgage broker who is 100% commission.
Does a mortgage broker take more money than like the bank would, or
no?
Is it the same?
No, you still have to be a prudent borrower. So you don't necessarily take the first offer, but you wouldn't also necessarily walk into Wells Fargo and just take what they said. You might check with B of A. You might.
Right.
So if you're getting a car loan, are you going to take the first offer that?
Yeah.
So you wouldn't do that. You still have to do the same thing. You got to be comfortable with the person you're talking to. Number one, they should be educating you. They should be teaching you, so you're in the position of making a decision. They're not just telling you what to do. And then hold them accountable. Check it out. Go talk to another one, right? Make sure that you're getting a fair deal, because it is somewhat subjective, and they only have what's available to them based on the company they work for, on what their margins are, right? And so you still need to do some shopping, but you got to find yourself somebody that you're comfortable with that really educates you. That's the number one thing. So reviews online, those are all great ways of kind of narrowing that down. But if you talk to them first, what's going to happen is this. You're going to do a loan application. And 99% of the time, that's just electronic now. And it's very easy to do right from your mobile device. You're going to give them supporting documentation. So depending on your circumstances, it may be your pay stub and W-2s. If you're self-employed, it might be your tax returns and your bank statements. They're going to tell you the list of items to get. ID as well. They're going to pull credit. You're going to review your credit together. Once they've got all of that, now they can say, Quinn, here's what you qualify for based on the amount of income that you have, the funds you have for down payment, and then they're going to give you options. If you say, look, that's not enough, I can afford more than that, but I've got write-offs. Okay, well, here's some alternative ways we can qualify you. Or can you get a cosigner? That's another option. A lot of these loans allow cosigners. Or maybe you don't have enough money for a down payment, and now you look at a down payment assistance program. There's a lot of those that are out there. So
you can finance the down payment too, pretty much, right?
Well, you're not even financing. A lot of these things are forgivable. So these DPA programs, down payment assistance, a lot of these, they're forgivable, meaning as long as you have that loan, you're in the property for at least 3 years or longer, and they all have different guidelines, then they'll forgive it, and that's free money. So there's a lot of these that are out there, but you're not going to get those options by going to a bank. You're going to get those by going to an individual mortgage broker that knows the market, that knows all the variety of product, and can work with you to analyze what the best loan program is for your needs. Now, once you get through that, you'll get a pre-approval letter. That pre-approval letter will be as good for as long as things don't change. You'll have to refresh or update documents in 90 days. New bank statement, things of that nature, it gets old. But as long as you don't take on additional debt, lose your job, like as long as the circumstances don't change, you'll still qualify for that loan and be pre-approved. Now you go out and you look at properties. Now you go out and you write an offer. And then your mortgage loan officer works directly with your agent to make sure that you have the best shot at getting your offer accepted. And here's what I mean by that. It's a competitive market, right? And so if you fall in love with a property, there's a chance there's somebody else that's going to fall in love with that same property. There's going to be multiple offers on it. If I'm the listing agent on that property and I'm working with the seller, I want to get them the best price. But I also want to make the best choice so that if Quinn gets into escrow on that and he maybe has a shaky loan, maybe he's putting 3% down and he doesn't have the best credit, but he still qualifies for a loan, but I've got somebody else that's putting 20% down and they're way more qualified. I might advised to go with that person for being less likely of falling out of escrow.
Yeah.
But if your loan officer reaches out to the listing agent and says, hey, Sally, seller agent, I work with Quinn. I've been doing this for 25 years. I know he's only putting 3% down, but trust me, he's very well qualified. Beyond that, I'm going to keep in touch with you every step of the way and let you know what's going on with the loan so that you never have to worry about it falling out of escrow. I've got a great track record. He's very motivated. He and his wife are just getting their family started. We really got to get them into a home. I would really love if you can give them a chance. And I know that they're willing to pay more for the property if there's a multiple offer situation, right? Because you've already told me you fall in love with it. Now that listing agent may be more apt to recommend yours because it is going to get the seller more money, but they feel more comfortable with that process. So you got to work with a loan officer who's also going to work in conjunction with your agent. Then once you get your offer accepted, then they can do their job to get your loan closed. But that's how you get it started.
I like that. I never thought about it like that before, but if you have that personal representative for you that's going to vouch for you and has that track record, I could see how that could totally push it over the line.
Yeah, I mean, the reality is they should be an advisor. They're not just doing your loan, they should be an advisor. And part of that is helping you. We get to see your entire portfolio, how you qualify, what your income is, what kind of assets you have, what your credit looks like. Think about how intimate we get with you. We see everything. So if that person also isn't helping you, hey, I noticed you're carrying some high interest rate credit card debt, but you have this cash over here that's only earning you 3%. You should take that and pay this off. It's going to save you a lot of money. And, and other things like that can really help. We get to see everything. So you want to work with somebody who's super professional.
How much money do you really need for a down payment in today's market? Is it the old 20% rule outdated, or is that still relevant?
No, that's not relevant at all. If you're a veteran, it's zero down. That is the best loan on the market. There is no better loan, low interest rate, no mortgage insurance requirement, and no down payment requirement. That is the best loan on the market. Now, you can also get into a loan with zero down on a DPA program. So DPA is down payment assistance. So let's say that you did a loan where...
How do you have to qualify for that, though?
All of them are different. Some of them are driven by median income in the area, as long as you're no more than the median income. Some are driven by other things. Some don't have those guidelines at all, but have limited money. So you got to get in there, and it's like a lottery. You got to get, put your application in and get approved. There's too many of them to talk about like one particular guideline. There's some out there that are actually not only will give you money for the down payment, but also money for closing costs. So you actually could get 101.5% loan to value, meaning you get 100%, no down payment, but they'll give you 1.5% toward your closing costs as well.
And closing costs is like your commission, the taxes, all the transfer,
all of that,
title,
and all the
escrow.
one-time fees. So yeah, title, escrow, appraisal, lender fees, tax service fees, all those things that you have to come up with in addition to your down payment. So the closing cost is everything, including, like you said, the commission side of it too.
That's amazing.
Yeah.
I didn't realize that because a lot of people now they rent, right? That's why all these people buy apartments at great investments, because people always need a place to live, right? And so you can, that money that you're paying in rent, you can literally probably figure out a way to pay something close to that, maybe even save some money and own something and start building some equity.
Yeah, I think that is the biggest misnomer.
People are just like, I don't have $300,000 saved right now, so I can't buy a house in California.
That's right.
That's the mindset. That's how I think, right? Mm-hmm. Like I'm thinking like, if I want to buy a house, Newport Beach is $3 million. I need $1 million down, but the smart thing to do would be thinking, okay, maybe go buy a house in Santa Ana or Anaheim right now or Fullerton for, $600,000-700,000, figure out the loan, the financing, I make money of a business and all these things, and start getting in it, make some equity, 2-3 years, maybe remodel it, sell the house, buy a nicer house, and then move up, right? That's the smart way. But a lot of people think are like, hey, I'm going to pay $5,000-6,000 a month on rent, and it's doing nothing for you. It's going straight down the drain.
That's it. There's no tax benefit. There's nothing. I spoke with somebody just this last weekend who's paying $7,000 a month for rent.
Yeah.
And does not, did you say that's me? Yeah. That's paying $7,000 a month for rent and doesn't own a home. Hasn't bought a first home yet.
What can you get if you're paying $7,000 a month?
Well, this is somebody who's in Colorado even. Yeah. And so they could easily buy $1 million home, and including taxes, insurance. After the tax break for getting the write-off for the interest and the property taxes, they'd save money. They wouldn't even have an outlay of that much, and they don't have to come up with a large down payment. This is somebody who could do 10% down easily. And so I think that's the biggest misnomer is people think they have to save up a lot of money to buy a house.
I think so.
Where if they just would speak with a professional loan officer, they could find out exactly what that is up front. And if they don't qualify, if there's some, for whatever reason they don't qualify today, they'll know what they need to do to qualify.
I have a lot of friends that have businesses or make some money, and they all rent. They live in nice apartments and, you know, amenities and all this stuff, but they're not, I mean, I think they want to buy a home, but they're just, they always stay in that cycle.
Do you think that they've never checked into it? Is that the thought?
Maybe, or maybe they checked into it like long ago and they haven't like gone back now that they've built something, and they're just, you know,
yeah,
that's their forefront of their mind is like the business, the problems, the things, and they're not thinking like about this, because this is buying a house too, right? Is part of like building wealth for 100%. Yourself and your family, right? Because it's like a sure way of saving money, right? Of course, you have home maintenance and you have to deal with the roof and the AC and all those things now, right? That you wanted if you're renting. But I think with the value of the equity and everything that goes up, and like it makes sense, like in the long run, right? Anyone who owns a home, my grandparents bought a home, what, $50,000, $20,000. Now it's worth $3 million, right? It's like,
I think that you nailed it. It's a sure way of saving money, because is a primary residence that you're living in the best investment? Not necessarily, but it's a sure way of saving money. And if you look at the history of property values over the last 50 years, there's only been 4 of those. Actually, over the last 75 years, there's only been 4 of those years where property values have gone down.
How do credit scores affect the mortgage approval and interest rates?
The lower your score, the higher the interest rate. It's pretty simple. The higher the score, the better the interest rate's going to be and the better loan product you're going to have.
Because you're a trusted buyer at that point. It's like, hey,
yeah,
you
it's just
pay off
think of
your
yourself
stuff
as being the lender.
Yeah.
Are you going to be more apt to give a better deal to somebody who has bad credit and is less likely to pay you back? No. So the lower you want to have the highest score possible. Now, there's a point at which it really doesn't matter. If you're over 740, it's going to be the same even if you're 800. But it's banded essentially in 20 points. So every 20 points, 740 and over, 720 to 740, 700 to 720. Every 20 points is going to be a little bit lower interest, a little bit higher interest rate the lower your score.
What's the current interest rates right now, beginning of September 2025?
Today, we just hit an 11-month low in interest rates today. And so the question you asked me is not really a great question. I love this, but asking what the interest rate is like this. What's the weather like in the United States? Do you have an answer for me?
You can't answer that because there's so much weather. There's different weather everywhere in the United States, right?
It depends.
Because it's not specific.
It's not specific enough.
Because I'm not giving you enough criteria.
Where are you
to
talking
give an
about?
answer,
Are you
right?
talking about in Miami? You're talking about Alabama, California,
so
Colorado? What time of year? What time of night? Day?
I didn't know this. So interest rates it's not
linear.
It's not like a current interest rate for the U.S. market. It's like in California, the rate is going to be different than Nebraska and in New York.
No, it's the same regardless of where it is, but it's what it takes to qualify for that loan. So if you ever look at interest rates that are quoted online, or you get a postcard or something like that,
that's like if you're the perfect qualifier.
Look at the fine print, what it says.
Okay.
Oh, this is based on 20% down purchase price, no more than $500,000 loan, 750 credit score. Full doc, it describes what that interest rate is.
So there's a lot of criteria.
There's a lot of criteria.
I understand.
Okay. So when somebody says,
really
what's your interest rate? Yeah, I like to
That's
tease
a great way to
say, well, what's weather like in the United States? There, it depends. You got to ask other questions. So, but what I will tell you is this: today, 11-month low, a 30-year fixed standard mortgage for Fannie Mae, Freddie Mac, conventional loan with high credit scores, 20% equity, et cetera, is about 6.5%. That's an 11-month low.
It was like it's crazy how it goes up and down. Do you think it will ever go back down to the 2 or 3% that we were getting like in that COVID time?
I don't know if it'll ever get. When I say ever, I mean who knows in the history of interest rates. I don't know.
But that was like a crazy time.
I wouldn't set any expectation for that. Just like I wouldn't, personally, I wouldn't expect there to be a housing crash anytime soon. I know people talk about it, and we do see pockets where we are seeing a decline of values. Not dramatic, but some decline because they were overbought and saturated, and they wanted way too much. To begin with, the value was really up there, but it'll still, based on current housing starts, new houses being built, and the population needs, we are still more than 6 years out before we have enough housing to meet the population needs.
What's the smartest way to shop for a mortgage without getting taken advantage of? Like, I know you said go with brokers. How do you find the right broker? How do you choose the right one?
Well, certainly referrals are a really great idea, but then it really is about going online and looking at reviews.
See what other people are saying about them.
Yeah, it's just like anything else. If you're going to hire a plumber, if you're going to hire, somebody to fix your washing machine, you may get referred from somebody, and that might be your first phone call. But you're also going to jump online and you're going to take a look at what people have to say. When you buy a product off of Amazon, do you buy the first one that pops up?
Usually I buy the one that has the most reviews and the most stars.
And then do you look at those?
No.
You never look at those stars. If you did, where would you go to when you looked at the reviews?
Lowest.
Why?
Because I want to know. I don't care about the good ones. I want to hear what went wrong and what's wrong with it, so I don't have the same problem. And if it looks too big of a red flag, I'll probably go buy it somewhere else.
That's right.
That's smart. I get what
exactly.
You're saying.
And so do the same thing. Why would you not do the same thing? If you're going to buy a product, if you needed another comb for your hair and you want to see what people say that these bristles are falling apart, then why wouldn't you do the same thing when you're shopping for a mortgage? Like, read the bad ones. Now, you can determine based on that, was that really this crazy person? Like, were they nuts? Like, did that make sense? What was the response? Did they reply to it? What did they say in the reply? You're not going to take bad reviews just for what they are. And certainly, if there's 95% of them are good and there's only a couple percent that are bad, you're going to take that with a grain of salt too. But that's where we go.
Adjustable rate versus fixed rate. What should first-time home buyers know?
Well, there hasn't been a lot of adjustable rate mortgages on the market in the last 10 years or so, and it's just based on what the yield curve has done. And so
what does it mean though?
What that means is that interest rates have a yield curve. So at every rate, it brings a different yield back to the investor. Okay, and the adjustable rate mortgages have not been in high demand for a long time. The yield curve has been inverted, which means the fixed interest rates are actually better than the adjustable interest rates. Now, that will change, and it's in the process. There are some adjustable rate mortgages today that actually do give you a benefit. Traditionally, people don't stay in their mortgages more than 5 to 7 years. And here's what I mean. They're either refinancing it or they're moving within that period of time. So most people don't keep their existing mortgage more than 5 to 7 years. Now, the anomaly is going to be the people that got 2, 3, 4% interest rate. Like those probably are going to stay the longest in those loans, but traditionally 5 to 7 years. So if you take an adjustable rate mortgage, if it makes sense and the adjustable rates are lower, you're probably going to save money in that period of time. It's just math. How much money a month are you going to save, and where's your break-even point if you would have taken a fixed rate? And if that break-even point is further out than you plan on being in the property, then grab the adjustable rate.
Do you recommend first-time home buyers purchase a starter home or go straight to an investment property?
It makes way more sense to buy your starter home first. You get better terms on that. in what we talked about earlier, instead of throwing away money on rent, you're using it as a piggy bank. You're putting your money into your home. If you find it hard to qualify for that, then do it with somebody. Do it with a partner or two partners or maybe three. So just like people will buy a house and they'll rent out rooms to help make the payments, you could buy a house, do it with a partner or two or three, and then see some appreciation, pull some cash out, and go buy another one until you can do it on your own. So if you're having a problem qualifying, that's not a bad option, but definitely a primary residence is going to get you the best terms.
How do young people know the difference between a good deal and a bad deal in real estate?
I don't know that you can tell the difference. I mean, that comes with experience. The quality of the home really doesn't matter if you're getting it at the right price, right? So if you're buying it and you know that there's work to be done, but you've got the money to do it, there's probably added value there. Whereas,
how do you figure out what that added value is? With the comps, or?
Yeah, you got to look at the comps. So that's the thing. Here's the biggest difference on residential versus commercial. Residential, it's all about the comps. It's all about what are the other homes in the area selling for that are similar to that home. On a commercial, it's based about the income.
The cap rate, right?
The cap rate. So the income that property throws off determines its value. The more income it's bringing in, the higher the value. So with a residential, you really just got to look at the comps and then get a feel for the market. So for example, I'm buying a house right now in Tennessee. It'd be my first one there. I haven't bought one there before. I don't really know the local market so much.
What are you doing with, like, flipping it, or
no? It'll be a hold. It'll be a long-term hold, midterm rental, long-term hold. But I didn't know anything about the market, so I did, talk to people that are out there, try and determine, what areas to look in, and then I had to rely on the comps. There was nothing else to rely on there. The deal itself was not based on income. It wasn't a commercial property. It's a residential property, so I had to look at the comps. And then we got the appraisal in, and the appraisal came in $70,000 higher than the purchase price. Plus, I'm getting all sorts of credits for closing costs. So the reality is, it turns out I think it's a really good deal, but that's what you have to rely on. So talk to a local agent, get a feel for areas, but then have them give you some comps in the area and what they're selling for. That's how you're going to feel more comfortable with it.
What do you think is the biggest misconception about building wealth through real estate?
That it's a straight line up. Okay. Yeah, values are not a straight line. Just like the stock market, values are going to go up, they're going to come down. You can't time the market, but the longer time you're in the market, the better the investment becomes.
That was going to be my next question. Like, is there a perfect time to buy the first home, or is that like a myth?
The best time to buy was yesterday.
So with interest rates moving up and down, they shouldn't wait. They should just jump in.
100%. And I say this all the time. The best time to buy was yesterday. The second best time is today. Why is that? Again, last 75 years, there's only been 5 years where property values have declined. So let's just say that things got crazy and we had a market that was as bad as the mortgage meltdown in 2007 to 2009 for the next 3 years. Well, if you hold on to it for 10 years, what difference does that make? So that's the biggest problem that people have, is they take advice from people that don't know. It's a friend, it's somebody at work. I've got so many stories about that. Just like I have this client. Oh my gosh, this one frustrates me so much. I have this client that I talked to about buying a home back in 2017-ish. And they wanted to buy this home. At the time, it was about $850,000, but they felt it was a real stretch. By the way, the house they were in, way too small for them. Their family was way too big. Every kid was sharing a room. They had 3 kids in a room. They had a big family. Way too small. This house would have been perfect for them. But somebody at work told them, wait, because the property values are going to come down. The market's going to crash. What's happened between that time and this time? it's gone completely the other direction. All the
housing
prices have
just
gone
kept
up,
going up.
But they listened to this guy at work that said, wait for the market to crash. It never crashed. Now that same house is like 1.7 million. Literally, it almost doubled in price.
Made all that money in the
and
equity
lived comfortably.
and lived comfortably.
So yeah, the reality is, again,
buy yesterday or today. Stop waiting on the interest rates and the market and everything, and just jump
unless
in.
you're a flipper, you're a short term. Then you got to be really careful with that. If you're not, if you don't want to keep your money in the property and you're doing, maybe using cash for flipping, then you got to be really careful on timing the market. But if you're buying your primary residence, just buy it sooner rather than later.
Yeah,
that's it.
So we talked about earlier how you've had these companies, over the decades. How have you built that kind of culture to have employees stay loyal to you?
It's really about caring for them. That's really what it's all about.
What does that look like for you?
I have helped employees buy homes. I've helped them with down payments. I've helped them when they've just needed something to get by, give them a helping hand, just really caring about them. When they're sick, don't give them a hard time. If they're sick, take the time. If there's something happens in their lives, go take care of that. We're here for you. Don't worry. We'll cover for you. Those are the things, just the human element of it, I think, is really what matters.
What's your leadership style when business is under stress?
Trying to rally the troops, encourage them, because if I'm under stress, they're under stress too. So being positive, come to the office with a positive attitude, lifting people up. We do something every day in our company. Micah, do you even see these? We do something every day. Every morning we use Microsoft Teams.
Like an all team meeting?
No, we have a channel in Teams. It's a good morning channel. And so because we have people West Coast and East Coast, like there's not a lot of connection between people every day.
Time zones, yeah.
And the time zones and so forth. So we when we wake up in the morning, we say good morning to everybody. And I think that small thing, hey, have a great day, or hey, here's what's going on today, guys. I got this. We have another channel. It's like a food channel that people put like, look at this dish I made, or a fun channel. I think those are the little things that in a society where people are remote and they're not really connected, coming to an office every day, you got to do some things that really help them to feel connected.
How did you scale like outside of California and into the other states?
That's a licensing thing.
So you just started getting the licenses and kept the brand and kind of copy and pasted the way you scaled here?
It's a process. The licensing is not easy from state to state. Some are easier than others. But yeah, there's a cost to it. And
how do you figure it out with lawyers? And
we have a compliance company that we outsource to. And they help us through that process in every state.
Because one of my goals is expanding this out of the state, so a compliance company can help with that?
Possibly. In the roofing industry, there's probably a company that helps with that type of licensing, and does it nationwide. I would look for that.
How do you hold your team accountable?
Results. It's all about the results. I don't care how they get there. I don't care how many hours it takes to get there. Let's see the results.
As far as HomePie goes, it's disrupting the real estate model. What's the vision behind it?
Yeah, that really came from having a mortgage business that's primarily consumer direct. So when you work as a mortgage company, when you work directly with borrowers that don't need an agent, meaning that maybe it's a family member selling a property to another family member. It's a landlord selling to a tenant, or just two people that know each other. They found each other. So for example, this morning, literally, we had somebody reach out that said, hey, I already have a buyer for my property. I just need somebody to help me with the paperwork. So they don't need an agent. They don't need to pay a real estate agent fee. They just need somebody to guide them through. Well, in the mortgage business, we really know the intricacies of what's involved from start to finish. We bring in the escrow company, the title company, et cetera. And so we know the ingredients. Now, when it's a peer-to-peer sale, there's no agent involved. There's not as much disclosure requirement. Some are required, some state requirements and things of that nature. But as long as you know what those are, you don't have all that paperwork that's generated to protect the licensed entities, the real estate entities. So I always thought about, gosh, for the people that sell by owner, how do they get through the process? Who guides them through that process? If a mortgage person isn't knowledgeable to walk them through, who does that? And so back in 2018, we started to see the advent of what's called proptech. Okay, so we've heard of fintech. PropTech is property technology. So these VC-backed firms started to come in and said, how do we disrupt real estate and make this, bring this archaic traditional approach to real estate to the forefront and digitize it and make it easier. And so their approach primarily focused on what I call institutional flipping. I'll explain what I mean by that. That was their primary focus, which, by the way, great idea and a need for it. But the model itself did not turn out to be the best model. So they started buying property. They come out and they say, we'll buy all cash, right? And you see these commercials all the time about buying. We'll buy your property all cash.
Yeah.
Don't worry about fixing it up. We'll take it we'll take it as is, right? You see those all the time.
Even, yeah.
You see billboards. You see all that. So these companies came in and said, hey, we could probably have somebody fill out a form online and have enough data that we could make an instant offer without even having to go out to the property. Well, that works where they started, which was buying it at a discount, which is typically about 30% discount. So in exchange for the hassle of showing your property, having people come in, fixing things, fixing the leaky sink and all these other things, the air conditioning wasn't working, that works for a lot of people. Or maybe it was, something coming out of probate or what have you. That works, right? I just want to get rid of this asset. But as the market heated up, so we went from 2018 to 19, and then think about 20.
COVID.
And now COVID hits, and now rates go down, and multiple offers on every property going into escrow in 24 hours. Now these companies couldn't acquire assets. So they kept on having to raise what they would pay for a property. They kept raising it. Now they're paying market value. Now, in order to get the volume, they were paying above market value.
What do they do with them, these companies?
They would go in, they'd just fix them up,
and they flip them.
Lipsticks, and then they would sell them, right? That works in a market where it's increasing every day. But as soon as that doesn't happen, what happens to them? They get stuck with assets. Now they have to sell off the assets at a loss. So what happened was, look, kudos to them. These guys made a ton of money. They came out with this business model. They built it up. COVID hits. 2020 goes by. They're doing this giant volume. They're up paying for these properties. Then they go public in 2021, 2022. And so there's a couple of them that did this. The biggest one is Open Door. So they obviously big payday, founders, all of that. They all benefited, but the business has really taken a beating. And I saw that at the very beginning. But anyway, so all this started to happen, and different ideas about disrupting real estate. And they had and some of these still exist today, but, where you can fractional ownership, which is like a timeshare for real estate. There are all these other ideas that, were being tested at the time. And I just said, look, for sale by owner has been around for decades. It's represented traditionally about 10% of the overall market, which is a giant beachhead market. How do we make it easier for them? And the sites that were out there servicing these people were really just billboards, without talking specifically about which ones they were. They're just billboards. It's like you go post on Craigslist, right? Okay, what is that really doing for you? There was no technology behind them, nothing guiding them through the process. If somebody didn't know what they were doing, they still didn't know what they were doing. And so I said, why don't we build some technology that guides somebody through the process where they can create a listing easily, just like you would like creating a listing for your car to sell it on Auto Trader. Upload your own photos to it if you want, or get a professional photo package, which is recommended. But be able to create a listing, then give them distribution. So give them the ability to syndicate and show up on Zillow and show up on Realtor.com and Homes.com and all these others, right? Hundreds of sites. Give them the distribution because that's what they need. They need the eyeballs. Mm-hmm. But then give them the communication so that they can speak directly with each other through the platform. So they don't have this awkward
They don't need to worry about brokers. It's
or
direct.
sharing their personal information or any of that. They don't have to do any of that. So have the communication piece, be able to show a property virtually if they wanted, which we thought about that even before
FaceTime
COVID.
kind of. Yep. Cool.
Or in person, if they're comfortable doing that. Give them the ability to hire somebody to show the property if they want to. And then when they're ready to make the offer, what really stands out as our proprietary technology that is just state of the art is we created an offer and negotiation tool that automatically produces the purchase agreement. So in a traditional world, to write an offer, you would talk to your agent. The agent works it up. They, ask you about all the details, how much down payment, do you want a contingency for appraisal or loan or inspection contingency, all these things. Do you need to sell your house before you buy this one? Is it contingent on your sale? All the things that go into that, they would fill out their forms, send it to their buyer to acknowledge it, typically digitally. They'd sign it digitally. Then they have to send that to the listing agent. And I'm telling you, it's the craziest thing. These listings, like a lot of them, they claim they never got it. Oh, they will email it to this email address. And especially in a market that's really robust where there's a lot of offers happening at once, it's like they miss it. So you're following up as the buyer's agent, you're following, did you get my offer? No, resend it. It's like archaic the way it happens. Then that listing agent has to go to the seller and get them to acknowledge that they received these offers. And then they have to create a separate counter offer and send that back to the buyer's agent, who then has to go to the buyer. And that process keeps going back and forth, maybe 4 or 5 times over a course of a week to get one agreement, to agree to terms. And it's just, there's so much red tape. So we basically digitize that whole thing and it happens instantly in real time. The offer is created with all the terms that go into the agreement digitally from your mobile device or computer. It instantly notifies the seller. Seller goes in, and it can be done with multiple offers as well. And they can accept, counter, or decline each of those terms. And then that instantly goes back to the buyer. Anyway, you can negotiate in hours what would take a week to do using the traditional. And then it automatically takes those final terms. There could be 4, 5, 6, 10 different counter offers. Because it's all digitized, it compiles it into all what the final terms are. There's a ledger that can always be audited, and you get one clean contract. How beautiful is that for the escrow officer or the attorney that has to decipher all those counter offers to figure out what the last terms were versus just getting one clean offer?
And then when you do like a for sale by owner, right? And you'd go through like the platform like yours, how does it actually close? Does it go still through escrow or title company?
All the traditional ways.
And then the lender can still be involved. The only part you're saving on is the big commission you would probably have to pay, right? I'm assuming that there's it's a less commission than if you went traditionally.
It's exactly right. The seller, what you said is absolutely true. All the same ingredients go in. You still have the title company, the escrow company, attorney, all the lender, unless it's all cash, you still have all of that. And it's all done really traditionally as far as that goes. So from contract to closing, it looks essentially the same, your inspections and all that. But if,
so you still have all the same protections as a seller or buyer. Yeah.
All of that. It's all the same. But the seller doesn't have to pay a listing agent. And the buyer, believe it or not, could still have a buyer's agent. Look, if you're buying a property in an area you don't know, there's a lot of value to having a buyer's agent teach you about an area. They deserve to get paid for that, or show you homes or what have you. They deserve to get paid. I've always said that the buyer's side agent actually has more value than the listing agent, where everybody thinks the opposite. Everybody thinks the listing agent has more value. No, I know my property. I know what I could sell it for. I know what the other properties in my area are selling for. I know what I've done to my property. I can certainly teach somebody about it. Why can't I sell my own property? I could sell it. But the buyer side isn't necessarily as easy, especially if you're a first-time buyer. You've never been through it before. You're probably going to want to talk to a real estate agent. In addition to buying in an area that you don't know, you're going to want them to teach you about the area.
But essentially, they could just go straight to the app and do it.
You can. I mean, there are definitely peer-to-peer transactions all the time on the platform. But we did make it buyer agent friendly. If a buyer does have an agent, the agent can guide them through that process on the platform and still get a commission.
Do you use ChatGPT or AI in your business?
Mm-hmm.
What's your favorite prompt?
What's my favorite prompt? Probably make this less aggressive.
What, like an email or a text or something?
Yeah. That's one way of using it. I mean, of course.
Are you pretty aggressive with your emails?
No, I just, I like how it changes the tone, but I really like it for personally.
Yeah,
is analyzing contracts.
Just upload the PDF and ask
questions about it, and hey, what are the what are the things I should be concerned about on this contract, or does this have this term in there, or this phrase, or does this allow me to do X, Y, Z? I find that to be beneficial from a personal standpoint, but we use it in our communication on our platform. And it is actually really good at using all the information we put in our blogs and all the data that we have to give really good answers to people.
How do you see AI reshaping the real estate and mortgage industries?
I think it helps streamline it a lot, especially mortgage. We're already seeing the ability for AI to analyze documents for loan approvals. And extract what somebody really makes for income, to be able to analyze tax returns and not, have an error made by an underwriter. We bring in, if a buyer or a borrower is willing to connect their accounts, which most people are today, then you could pretty much just have AI do the full analysis of that loan and issue an approval today.
Are you going to use it in HomePie? Is AI gonna? You do already?
We already do.
That's amazing.
Yeah.
So where can people find you, follow your journey, and invest alongside you?
So best way to reach me is to go to thebradrice.com, and on there they'll get all my contact information for my mortgage company, which is Amerifund, for my socials, for HomePie. All the information is there on thebradrice.com.
Brad, that was powerful. I appreciate you pulling back the curtain, sharing your journey, the wins, losses, mindset, and strategy. These are the kind of conversations that move people forward, and I know this one will stick with our audience. Thank you for tuning in to Built to Scale. If you got value from today's episode, do me a quick favor, subscribe, leave a review, and share this with someone building something great. Your support helps the show grow and makes it easier for me to bring on even bigger names and incredible guests like Brad Rice, so thank you. Follow me at Quinn Vincent on Instagram, YouTube, LinkedIn, and TikTok for daily behind the scenes, insights, and momentum to fuel your journey. Until next time, keep building, keep believing, and remember, legacy isn't given, it's built.